YieldMax's MSTY versus Harvest's MSTY. This is US versus Canada. This is more competitive than the trade wars, than our hockey games versus each other. This is the US-Canada battle. My name is Forrest Hodel. I'm a Bitcoin educator and Bitcoin coach. And if you need some help with Bitcoin security questions, all that, you can book me for a one-on-one consult, which is in the link in the description. So let's take a look at these two funds. I've talked about them individually. They're also interesting to talk about because one of them is a standard covered call strategy and the other is a synthetic covered call strategy. So even if you're not Canadian, even if you're not from the States, you might learn something from this video just by understanding the difference between these two strategies, which you can implement yourself. And we're going to just get into how they implement it as ETF issuers. So first, let's take a look at the more popular out of the two. This is YieldMax's MSTY fund, which is a MSTR option income strategy. Their distribution rate here with an asterisk is 77%. And they have all of their distributions here, which are quite large. The objective of this strategy is to seek exposure to the share price of the common stock of MSTR and also spit out income in dividends to the individuals holding the funds. So they write calls or sell call options on MSTR, and they harvest the premium basically from the volatility within there. That's a broad overview of what they do. Their closing share price right now is $22. They have $2 billion of assets under management, which is just a pretty big fund at this point. And they charge an expense fee of 0.99, so basically 1% they charge in fees. So what they hold is quite interesting. So there's some laws within the US of not being allowed to be too concentrated in one equity. However, US Treasury bonds are exempt from that. So you can actually see the way that they've built this fund is they hold a vast majority of the fund in US debt obligations, and they actually borrow against these or use these as collateral to then do a synthetic covered call strategy. So their covered call strategy right here are two different strike prices and two different expirations. Well, actually, these are the same expiration, two different long dated calls, and they hold a bunch of them. So shares here, they hold a ton of both of these. But in the fund, comparatively, it's only 8 and 5% basically. And then what they do on top of this is they sell short-dated call options that are affected more by theta decay and are perhaps out of the money to some degree. It's really dependent on what the MSTY team decides to do, but they hold these call options, these long-dated ones, as if they are holding underlying shares. Now, this works because it exposes them to the price fluctuation. So if MSTR's price goes up, there's going to be a multiple because the options are a leveraged form of long exposure to that. So these act as a way to expose yourself to more of the underlying with less amount of capital. So you can be more efficient with your capital in this kind of strategy, or you can hold a position that acts like shares do, but to a more extreme side. Now, this can go for you. This can work for you, this kind of synthetic covered call. It can also work against you really in a very fast way as well. Say there's a large drawdown. These start going out of the money like crazy. They stop. They start acting a lot less like shares, and they amplify the losses as well. They amplify the gains. They amplify the losses. That's what options do. So you're going to You're also opening yourself up when you hold a long option there is something called theta decay, which is time decay. So over time, the part of the option, the part of the value of the the option is how far away it is to expiry. So as that expiry date becomes closer and closer, that option becomes worth less and less intrinsically. So there is that to know. There's some additional information here, but just from what I know about this fund as well, they do something called return of capital, which means that say you invest $10, if one of their distribution amounts is 10% return of capital and they distribute monthly, it means that first distribution of 10% return of capital is going to return you $1 of your own investment into the fund. Now, there's a couple reasons they do this. One of the reasons is because this fund is really orientated towards income. So they want to provide their shareholders, the ETF buyers, with a sense of income from investing in this fund. The other reason they do it is it juices the returns that people see if they don't understand that some of it is their own capital getting returned to them. And the other reason they do it is because it keeps the share price low, which keeps it attractive and interesting for people to be able to buy smaller amounts of it. Now, the problem with that is if you're really looking at this fund and you're thinking, I want to keep this amount of money invested in it. Well, every single month, some of that money is getting given back to you. So it kind of requires you to keep investing into this fund if you want to keep the same amount of working capital at work. And that's kind of without everything else going on. If that was only the idea that you're getting your own capital returned to you and the capital of the other investors, well, that is what a Ponzi scheme is. But there's everything else going on top of this as well. There is the active management. There is some of the premium getting returned to you is actually or some of the distribution that is returned to you is actual premium as well. And that can fluctuate based on how successful they are at running this synthetic covered call and how basically the volatility of the underlying and everything else too depends on so much. So you can see these amounts fluctuate a lot, and a lot of that is just determined on how much they decide to return to you and how much they are actually making from this strategy. Now, before we move on to the Canadian one, they do have other ETFs. They have other yield-bearing ETFs. Tesla was a really popular one, which because it worked on Tesla, it was also a very volatile stock. Now, it's actually performed pretty horribly. It's returned a lot to people in the form of income, but it has not appreciated in price. Now, people are kind of hoping that MSTY will stay even. There's people that think maybe it'll perform kind of like Bitcoin will, not necessarily keep pace with MSTR because it's paying out so much, and maybe it'll underperform MSTR just with the strategy they're doing regardless of the return of capital. But they're kind of thinking, well, it's going to perform maybe as well as Bitcoin does. Now, I don't necessarily agree with that. And we can maybe look at some charts as well later on in this. But let's first take a look at MSTY, the Canadian version. And this is a traditional covered call strategy ETF. So the other one was a synthetic covered call using long dated options as their long position and selling short dated calls against that long position. Now, what MSTY in Canada is doing is they are actually buying shares. So they're not opening themselves up to theta decay with that. And they're selling covered calls on 50% of those shares. So a covered call strategy, it works in kind of a sideways market if it's managed well. It can kind of hedge you on the way down if you're in a downwards market. It's not going to break even in a downwards market, but it'll maybe offset some of the downside. And it's going to cap your upside in an upwards market, especially if it moves upwards really quickly and puts a lot of your covered calls in the money and those calls get taken away from you, or those shares get taken away from you. So they sell covered calls on 50% of it, which means that you're still opening yourself up to 50% of those shares having uncapped gain to the upside. So you are benefiting from upside movement as well, which means that it's going to track MSTR fairly well, but be muted to the upside and be paying out that dividend instead. So they have a a more fixed dividend rate, at least so far. But I have heard talks from the manager of this fund that says instead of NAV eroding, instead of paying out return of capital, instead of paying that back to the shareholders, what they would do is they would either reduce the dividend or increase the dividend, and they would have a minimum dividend of, I believe, 24 or 23 cents. I can't remember exactly, but they also plan, they hope that this strategy becomes so successful that they're able to increase the dividend without actually giving people back their initial invested capital. So right now they're paying 40 cents. Their market close was $11.23, and they have an expense ratio of 0.4%. So less than half of what the other MSTY fund charges to do this. Now they only have 75 million under management compared to the 2 billion of the MSTY in the US. And it's Canadian unhedged, which means that we're also seeing price appreciation of this equity in Canadian dollars based if the US dollar currency outperforms the Canadian. So it's not hedging that to the Canadian dollar. So it's exposing Canadians to a US equity in US dollars. But it is priced in Canadian dollars. It's just unhedged to the Canadian dollar. The other thing I will mention about MSTY is that it is fairly new. It's only had 2 distributions so far, and the next one is coming up in around a week or so. And you can see their holdings are 101%. So they're a little over, they might have taken on a little bit of leverage or something like that. They're a little over allocated, but that's to MSTR stock. And they have, so here they have that the 0.2 in negative of cash. So they're holding a tiny little bit of debt while they probably balance some things out and whatnot. And then they have the market value of their options is negative 1%. So they're selling calls on the fund or on the shares that they own. So one chart here that we'll first look at is MSTY versus MSTY. So in the candles here, we have the Canadian MSTY, and in the lines, we have the American MSTY. Since the inception of Canadian MSTY, there's no point to go back further than that with this specific comparison. So you can see 9% negative on Canadian MSTY, negative 22% on the American MSTY, and they both would have had the same amount of payouts, but the payout would have been different and potentially offset because of the larger payments. So this is some real just like head math here, but MSTY American one is roughly twice the price, even more than that because it's in US dollars, but let's just say it's twice the price of Canadian MSTY. Canadian MSTY pays out 40 cents, whereas the US MSTY has paid out basically $1.33 per share. If we half that, it's 65 cents US, which is more like $1 Canadian. So they've paid out more than twice as much. They've paid out basically $2, where Canadian MSTY would have paid out around 80 cents. Now, does that offset the double loss? Right, twice as much loss in the price of shares with the American MSTY or not. This is all short term. You can see that there are correlations. The price movements are very similar. We're in a little uptrend here. We're in an uptrend here. We've gone down there. We've gone down here. Right, it is moving the same. It's just the amount of it is moving different, and the payouts might be part of the difference there between the two. So one is maybe holding up more value in its share price, and one of it is paying out more. So now this chart here, what I'm looking at is since inception of the YieldMax American MSTY, which was roughly February of last year. We can see that IBIT, we're comparing it against IBIT, which is a Bitcoin spot instrument that trades at the market times, so it's more accurate for this measurement. We can see IBIT is up 78.8% and MSTY is up 10.89% with all of these distributions happening. And we can look at the distribution rate monthly here, which will be fairly accurate. So 77%. If we add 77 to the 10, we're actually at 87, and that's without dividends reinvested. That is actually taking that out as income. You're at about 88% up on MSTY, whereas you would be up 78% on just Bitcoin in an ETF. So the theory, right, the theory that some people have has played out, where MSTY has performed like IBIT, but is paying out. It's not performing, it's not at 77 with its share price plus paying out. It is basically performing like Bitcoin, but you're taking some of that equity out. In my opinion, that is not really what you want to do. I mean, to me, you have a lot less risk actually holding Bitcoin and selling some of that off if you needed income, and you would be doing essentially the same thing as what you're doing here with MSTY, except you're not taking all of this counterparty risk, or as much potential counterparty risk as you are with MSTY. Again, that's my own personal opinion, and there might also be tax implications with this as well. So MSTY pays out this dividend. If you don't have it in a tax advantaged account, you might be paying a lot of tax on that. Now you do have to maybe figure out what is return of investment versus what is dividends. Maybe those things will be taxed differently depending on where you are. And really, a lot of this comes down to the tax treatment of these things. Now, mentally, it might be easier as well for somebody to just hold this, get the income from it, as opposed to mentally not really wanting to sell parts of their Bitcoin for income, even though essentially this is a similar thing to what they would be doing if they were doing that. It goes about it in a different way, but you could replicate it as far as growth and income in that same way, potentially, as far as what we've seen historically with its prices. So as far as who this might be right for, let's first look at the Canadians out there. I think if you're Canadian, I would maybe look at my last video about MSTY that I did, which is a much deeper dive, and I would think about doing that strategy. So we have something called a TFSA, tax-free savings account, and what my understanding is what you could do is you could hold the Canadian version of MSTY within there, and you're paid out the dividends, and you would be able to take that out of your TFSA. You know, there is contribution room allotment that you have to be aware of and all of this. But once you figure that out, you could take those dividends out, and that wouldn't be taxed as income. Now, as a Canadian, if you were to buy MSTY, you see how much more income it can provide and all of this. Now, if you were to put that US equity into a TFSA, immediately you're getting hit with a 15% withholding tax from the IRS. And so that's going to take a huge amount of those gains away from you for, in my opinion, absolutely no good reason. And so then you're left with less benefit from holding something like that. My understanding is you also are hit with that withholding tax if you hold it in a margin or an individual account as well. The only way to avoid that would to be hold it in a RRSP, which is tax deferred. So eventually you're going to pay taxes on whatever you make within there. But you're not able to withdraw that as income. And in my opinion, that defeats the purpose of holding an income fund like this, especially where the underlying, in my opinion, is going to outperform a strategy like this in the long term if you're looking at total return. So it would make a lot more sense in an RSP to actually hold MSTR, in my opinion, than to hold MSTY, because you lose the benefits of this income strategy within an RRSP, because it's not designed to be able to be withdrawn upon like a TFSA would be, or even a margin account would be. Now, the other chart to look at here is since inception, MSTY Canadian versus IBIT, and you can see the two payouts again, and IBIT is down in this time frame, basically -7, while as MSTY is down -13, so almost double. And again, that is with the payouts of about 8%. So that 8% actually will offset this, or it depends. I mean, that 8%, that yield that I talked about, that's not totally accurate, and that's for 2 months, so 4% per month. That's only accurate if you buy MSTY at exactly $10 per share. Then you're getting a 4% per month yield on that. with that dividend. So it really depends when you bought it. If you bought it all the way up here, you're going to be paying like $14 a share. Then that isn't going to be 8%, and then that isn't going to outperform or perform in line with IBIT. But it's roughly around it with the distribution is what I'm seeing so far since inception. And again, we only have back until mid-January was when this MSTY was first launched. So we don't have a lot of data. We don't know how this would perform in a bear market. We don't know how it's going to maybe potentially underperform in a bull market as well, in a rapid bull market, right? Because a covered call strategy does not particularly do super well in a rapid increasing environment for the underlying. Now, if you're American, of course, the MSTY Canadian product, I don't really see any advantage for you to hold that. It doesn't really seem like the accounts, the Roth IRAs, the different accounts that you guys have for tax advantage, it doesn't seem like it will lend itself to you holding a Canadian product. It doesn't really make any sense. So you're kind of going to be looking at MSTY or maybe iMist. There's a few other ones as well that orientate themselves around Bitcoin, although Bitcoin has basically around half the volatility that MSTR does. So your payouts are going to be smaller on a Bitcoin centered covered call fund, whether synthetic or not. And so you're really looking at MSTY, and then you're deciding, is this something that is better than me just selling my Bitcoin or selling my MSTR shares when needed to supplement my income or to be my income? How long does that play out for? Is MSTY sort of that headache-free way to do this? Does it apply more risk than I might realize? Is there a possibility for this fund to really perform negatively and not see the upside if the synthetic calls go against them? There's all sorts of different things that you should be thinking of. And in my opinion, this is just my opinion, the Canadian structure, the structure of the Canadian Harvest Fund is much more appealing to me. You don't open up yourself to theta decay with the synthetic calls. You don't have large outsized downside risk when the share price goes down, as you do with a synthetic position. And you have upside potential for 50% of your stack while still having some income. So you're exposing yourself to MSTR, which I'm a big believer in, and you're taking a little bit out here and there just automatically through the distribution, and that could supplement your income in a big way, and you could do that in a tax advantaged way as a Canadian. So to me, the structure of it makes a lot more sense as a Canadian, and as an American, I don't know if MSTY is going to be your best option. I don't know. It really depends again on your situation, whether you're really trying to find income orientated stuff, and if you're okay with NAV erosion, return of capital, and you're kind of in a position where you're living off your investments, maybe you're retired or whatnot, and you're okay with maybe some of the value or missing out on some of the upside of these growth potential stocks, and you're looking, what I've seen actually is a lot of passive income investors that have lower risk, lower yielding stuff, and they put something like MSTY in there to just kind of juice the dividend returns, knowing that there could be potential issues with their investment value actually deteriorating in some ways, but realizing that they're kind of needing a juicier income stream currently, and they're accepting the potential consequences of that by holding that. It's not something I would ever want to put all of my eggs into. You should have a good basket and to hold your eggs, and I'm not 100% sure that really either of these products are, but as far as the way they're structured, I do see the foundation and the structure of the Canadian one to be a little more sturdy and stable and steady potentially in the long run, with less income back to you, but that's part of the price to pay for potentially more stable structure, in my opinion. So hopefully this was helpful. Hopefully this wasn't just only for the Canadians out there. Hopefully some Americans learned something about maybe the difference between regular covered calls and synthetics. If you have any additional questions about this or anything else, the YouTube comment section is the best place for that. And again, I am a Bitcoin coach. If you wanted some help with anything Bitcoin related, you can just give me an email, and there's a link in the description for that. And if you wanted to buy some Bitcoin directly instead of all this income stuff, check out Bitcoin Well. It's where I buy all of my Bitcoin. They're a non-custodial exchange, which means they send you Bitcoin directly. They have non-KYC options available, and they have the lowest spreads for a non-custodial exchange. And if you need to preserve your seed phrase for future generations or for whatever, I would check out the Stampseed kit. You can get 15% off using my code BTC not crypto 15, and they have an amazing titanium seed plate stamping kit that is the best out there in my opinion. So thanks everyone for watching, and we'll see you on the next episode of Bitcoin Not Crypto.